Wonderful. Hello, how are you? Thank you for joining us in this particular session when we are studying the market structure. Market structure. Forex has its own market structure, and that's what we're going to deal with today. We're going to deal with understanding the market structure. My name is Vincent Mungai, and I hope that I am mentoring you in the right direction as you continue in this basis or the beginner's course. We have dealt with several modules. You've done a number of modules. Module 1 was introduction. Module 2, after you knew what Forex trading is all about, you got to know about currencies. We moved on to understand about the pairs. We studied about the brokers that we have to engage with. We went on to understand how we get to engage using our platform. We get something called lots. We make our positions based on lots, and after we make our positions based on lots, we went ahead to look at several things. We looked at candles and how candles have different shapes, how they have different signals that they give us. They give us the opening. They give us information on the opening. They tell us about the closing position. They tell us about the how high the market was and how low it was. So using candles, we were able to understand a few things. Then we moved on to patterns. When those candles are in a certain alignment, in a certain shape, we said that we have to understand this, and we moved on to deal with the pattern of whether they are bullish, the trends, whether they are a bullish trend or is it a bearish trend. We moved on and we finalized that particular module. I think module 3, we finalized it with nothing other than indicators. So we got to see that there are indicators, and although indicators are lagging, meaning that they stay behind, a short step behind, however, they are very important because they show us several other additions that we need to know in the market. They show us the volume of the market. They can show us the trend, whether the trend is about to switch one direction to the other. Those reversals, we're able to get them from the trends. Now, when we're talking about market structure today, I want you to pay attention, because market structure is a very important course altogether. Market structure is very important when you move on to decide which position you're going to take on a certain asset. You will need to have an understanding of the market to be able to determine which direction it's going. Now, I hope you guys can remember that we said that whenever you open, whenever you set and you're ready to trade, we say that you have to be aware about the fundamentals. So we're dealing with the technicals, but the fundamentals have to be in our mind. So let me just throw in this for free as a reminder. Remember to just log in, go into your forexfactory.com, and when you go into forexfactory.com, you just go ahead, you check different currencies up there, different pairs basically. The second section is very important. That's a section where you have the news of the day. You can log in there and check. Make sure you check what's happening today, what's happening the following day, so that you have a general idea. Whatever is marked in red means that it has a high impact. It's an information that has, or is that it has a potential that will affect the market in a strong way. So these are some of the things coming up. Like, for instance, this week we have job openings, we have CB consumer confidence, two things that are coming up tomorrow, Tuesday. Then we have other things coming up in the course of the week. By the time you're watching this, that month, believe you me, there will be other things that will be coming up, and you will need to have information of how we usually check these things. So make it a habit to, when you log in, open Forex Factory, have an overview of what's happening before you, have information on what's happening at the back of your mind, where announcements are concerned, fundamentals. But over and above that, now you can go ahead and mark those fundamentals depending on the pairs that you're trading. You mark those particular announcements in advance on your form. You go to your particular you go to your particular currency pair. Okay, I want to do that right now. You're in the currency pair over there, and in my currency pair here, what I have done is I have marked a specific. You can see, like, there's a line I have put in there, a line in blue. The same way there's that line in blue. Okay, that particular line there in my trading view, it has an announcement here. It was a previous, I think last week, I had put non-farm employment change, and I was expecting that to happen. Notice that when that happened, there was a spike. You see this spike? That's why we mark those announcements, so that they don't find us in the wrong place. You can see that particular place where I have marked in blue, right here, where the US index is concerned, because this is the US index here, US dollar index. So I had marked based on the announcement. So let me just move over now. That was just I was just throwing that in for you as I move on. Was throwing that in as I move on to today's course and today's lesson on market structure. So market structure, what is it? Let's go in and say market structure refers to the organization and behavior of buyers and sellers in a market. It is a concept that describes how prices are determined and how different market participants interact with each other. So what we are saying here is that market structure is about this interaction between the bulls and the bears, the buyers and the sellers. So that interaction, that tug of war between them, creates a certain structure, and that structure is important for us to view. We said that we're gonna exhaust the theory before we move into the practicals, and this is the way that we should be able to learn and perfect Forex. We first of all understand these behaviors, this market structure. How does a market behave before we jump into doing the orders and doing the particular trades? We will have time to do those trades in a jiffy. So the market structure is determined by the number and size of market participants, the type of trades they make, and the level of competition between them. Good. It can also be described as the framework that describes the relationships between buyers and sellers. Understanding market structure is essential for traders as it provides clues to market sentiment and potential price movements. So the moment you spend time understanding structure, understanding the movement that is going to be depicted in the charts, then the better it is for you. The better it is for you to understand what and predict what is the next move the pair or the asset that you have might take. So let us just take into let us note those particular things that market structure is about. The bears and the bulls. It's about that interaction between these people who are buying or these who are selling. Those who believe the currency will go up and appreciate, or it will go down as a depreciation. So we can continue and say that there is a bullish structure. So the bullish market structure looks like this. A bullish structure comprises a higher high, HH, series along with higher lows, HL. So I have marked on the right side of your screen. You've seen there that there are higher highs and there are higher lows. So those higher highs and higher lows are what we are talking about here, and we are saying that when you see that, we call it a bullish structure. When you see that the higher there's a higher, the highest point of that particular candle is higher than the highest point of the previous section. So you can see you can be able to create those higher highs and higher lows. Then you can call that a bullish structure. And of course, there's an explanation here that bulls are bullish because they believe that the demand for a given currency will increase in the future, leading to an overall rise in price. This sentiment is often reinforced by positive economic news, increasing investor confidence, or a surge in trading activity. So that's what we were saying a little earlier before we moved into market structure, that the fundamentals, that information that you get in forexfactory.com and other sources, because there are many other sources of getting to know the economic calendar. It's called the economic calendar. So that information sometimes is responsible for that change that happens and the trend that the trend that follows because of those kind of announcements. Excuse me. So those are the that in a nutshell, that's how the bullish market behaves. It behaves that way, where it goes higher. You have higher highs and higher lows. Key features of a bullish market structure include a strong upward trend with rising prices and trading activity. Other components include high trading volumes. That's something else that comes. Positive economic indicators, and an overall optimistic outlook from investors. So investors at this particular time are feeling that bullish sentiment, and they have a sense of they have a sense, or rather they have a mood of buying, because they are seeing that particular currency pair, that one currency is going to be is going to become stronger than the other, to their benefit, of course. So that forms a certain structure. If we can just proceed on, still talking about structures, is that now there's the bearish structure. This is virtually just going to be the opposite of the previous. So a bearish market structure in Forex is characterized by a downward trend where the bears take control of the market and push prices lower. This market structure is typically marked by lower highs and lower lows, with buyers losing confidence and selling pressure dominating the market. So self-explanatory, it's just an opposite of the previous. Direction-wise, it goes the opposite. Bearish market structures can be identified by several indicators, such as price action patterns, moving averages, and trend lines. The key components of a bearish market structure include, let us look at these particular components. These are the components. You have lower highs. Okay, as the market moves lower, the swing highs progressively lower, reflecting the bearish sentiment. Okay, you have lower lows. The lows also continue to move lower, creating a series of lower lows that indicate the strength of the bearish trend. Then there's something else there we had included, and it's important for you to notice. There's something we call breakouts. Breakouts, we will explain this a little more a little later. That breakouts in a bearish market structure, prices often break below key support levels, triggering a cascade of selling pressure. So this is what happens in a market, in a bearish market structure, that you have these breakouts breaking below key support levels, triggering a cascade of selling pressure. People begin to sell. Nobody wants to hold that stock or that currency or that commodity, because it's losing value. So it's a sell. Okay, momentum. Bearish market structure often accompanies strong momentum as traders rush to sell and take profits. If you don't take profits today, if it's falling, tomorrow it's going to be you're gonna incur losses if you don't sell today. So there's that rush, that momentum increases. Then the volume tends to increase during bearish phases as traders look to exit the positions that they had in order not to lose. So you have to be alert. Okay, I think there's a part you can't see there, so I'll let you see it. Volume tends to increase during bearish phase as traders look to exit positions and avoid further losses. So it's important for us to notice this particular trend, what happens in a bearish time, so that we are able to notice this when we come to actual images or actual charts where those things are happening. Now there's another one called the sideways structure. Here it is. The sideways structure is right there. You can see the sideways. It's also called choppy market structure, also known as a consolidation market. It's a type of market where the prices appear to move sideways within a relatively narrow range over a period of time. This market structure is often characterized by indecisive price action, low trading volumes, choppy and uncertain character, and making it difficult to trade. So when you notice that it's a sideways structure and the market is erratic, that's the word I had used in a previous class. This is a market you need to be careful. Don't engage. You can pause for a while. Now, we've continued to say there that this indicates the presence of buyers in the market who are driving the price up. The price's horizontal movement is showcased by equal highs and equal lows. So it's showcased by buyers in the market who are driving the price up. So they are maintaining a certain height, and they are reinforcing, they are refusing to let go, and they are pushing that market to become a sideways market. Now, there are features that have been identified of a sideways market. And here we have about 5 of them. Price action moves sideways within a relatively narrow range. Decisive price action and low trading volumes characterize the market. Then there is determining the market's direction is often difficult, and traders may hesitate to place trades. Prices will often test the range's upper and lower boundary multiple times before eventually breaking out. Okay, so these are all the things that we notice. Then the last one there, significant price movements can follow sideways market structures once a breakout follow sideways market structures once a breakout occurs. So here we are noticing all these different things about the sideways market so that we can know it. Going back, we said that we have several markets. We have the bullish structure in the market. You can have the bearish market structure. You can have the range market structure. You can have the choppy, this whole sideways market. All right, now before we move on to the issues that I would like you to note, I think I would interject at this point and caution that the way that we draw these drawings, we draw them, in zigzags, up, down, and I've shown it to you previously. What you see in the textbook is not what you see when you come to the software. In the software, it could have more zigzags, but they still form the same thing that we're talking about. If I can just briefly just move into the software here, so that we can have an idea of what we're saying. We're saying that within these movements that are there, okay, within this movement, sometimes it can't be it's not a clear. For instance, now, when we look at this particular trend, how it's moving here. Okay, let's use this one. It's a downtrend. From here, you can see it's moving down this way. Okay, but in essence, it didn't move in a straight line. If we were using a line here, then it would still help us understand that the price did not move from 104,701 to 102,501. It did not drop. The price did not drop from this level to this level in a straight line. There's a lot of zigzagging. But there are still higher low. There are still lower lows. This was the low over here. It went high, stayed around there. It came. This is the next low. So there's a lower low. Okay, then it came here, then it came here. This is a lower low from this one, and this is a lower low from this one, and this one is lower than this one. So that kind of a movement. Let's pull back to our candles. So that is the scenario. So don't expect that the way we have drawn the lines in the theory is how they will appear in the particular chart. So there's going to be a difference. There's also a difference when you look at different times. Like now here we are on a 1 day. If you move to 4 hours, let's see how it looks on the 4 hours. Where is our line? Our line is not even visible. But anyway, we can still be able to check on the 4 hours. We can still be able to adjust here and check to see what is happening. There was a point at which it was going down. There was a point at which it's going higher, but it doesn't move as a straight line. There is that play on the market. However, it still gives us a particular a trend or a particular direction that it is heading. So the structure, that's what we are studying. Market structure now is about understanding the game between or the fight. It's actually like a war between, it's not a game, it's a war between the buyers and the sellers. Don't forget, my friend, that the stock market and the forex and this whole industry, it's a zero-sum game. What does that mean? It means that for every penny you gain, someone has lost, and for everything you lose, someone gains. So it's war. And that structure, you have to understand that structure. When prices are going up and down, when the bulls or the bears are having the day, what are you supposed to get from that to determine the future? You're supposed to understand that there's a structure being built. There's a structure in progress. So then now we can move on to the notes that I had mentioned. And the notes that I had mentioned to you. Okay, let's see. The notes was somewhere here. Where are my notes? Here. Market structure can be indicated, I beg your pardon, in Forex through various strategies and approaches. Here are some tips. So number one, pay attention to price action. You can understand the market structure by analyzing market movements, okay, and candlestick patterns. We've already dealt with candlestick patterns. Now you begin to see how they come in. They're important because they help you understand what's going on in the market. Now, another thing to note is look at key levels. Identifying support and resistance levels can help give you an idea of the market structure. So don't worry about support and resistance, because that's what we're moving into next. The next lesson after this one deals with support and resistance. We will deal with support and resistance. We will also deal with supply and demand. So you will understand how all these things play together like a symphony, and they all, it's like an orchestra, and they all come together to show you the structure of the market and give you a good advice on what direction you should go. So another point here is look at key levels, identifying support risk. Okay, that one we've read, and we have said it can help give you an idea of the market structure. Now, another thing is assess the market trend. Assess the market trend. Identify the direction the market is moving in and its strength. It's not just the direction, but the strength. How much, what is its velocity? What is its weight? Yeah. It's not just throwing punches, but how heavy are those punches? So you can look at the candles and look, how strong are they? Okay, are they just small movements, small candles with a small body, or are they pushing big, bold solids and the shape of the candle? The other thing is to note that you can use technical indicators. Now, here we dealt with indicators in the past module. Indicators such as moving average, RSI, MACD can provide insight into the market structure. They can help you. They can add confluence to what you understand in the market structure, so that you can make your decision. Now, another thing, and the final one here, is consider the market volatility. High volatility indicates structural changes in the market. When you see that the market has become volatile, that fast movement, it indicates that there is a structural change in the market. And when you see that, it means some people are losing, others are gaining. All right, using multiple time frames. You notice that when I was when we did the sample there, and I was trying to show you that the market goes in more zigzags than is visible in the theory. We change the time frame, and when you change the time frame, it helps you to be more clear. So you switch between higher time frames and lower time frames, so that you see what's happening on an hourly level. But then again, you go down and see what's happening like on 30 minutes level, so that you see the volatility, you see the structure, how the bulls and the bears are drawing at each other. How are the punches coming in? That's what you're looking at, and that's what this particular point is trying to show. that you can use multiple time frames. New traders can benefit from using multiple time frames, such as daily, hourly, and 15-minute charts. This will help them to identify the market structure over different time periods and gain a better understanding of the trend. Remember, we are looking to be on the same page with the trend. If the trend, it's time to sell, we want to be on that selling trend. If it's time to buy, we want to be on that buying trend. Now, analyze different assets. Traders can analyze multiple currency pairs to gain better understanding of the market structure. They should look for similarities and differences in price action to determine the best trading opportunities. So, guys, after we're done with market structure, we move into support, resistance and support. We will have completed the issue of technical analysis and all that, and now we'll be moving into making orders. So we're going to be dealing with now the actual making orders and the risk management. So this issue of market structure and analyzing your market structure and marking it, because you've got to mark the market structure. It's not just an issue, a situation where you just know that the market structure is like this and like that. No. You have got to put that information on your platform, and that's why you have that trading platform, so that if you're using TradingView, go now and look for the pen, so that you'll be able to mark out those things or those places where you see that there's a market direction in certain way. We want you to mark it. Don't go too far back. Just stay within a range. You want to look at what has been happening in the last 1 week. You want to look at what has been happening in the last couple of days. You want to look at what is happening today in the last couple of hours, and then you want to now make a decision on what position can you take or not take. Because sometimes you're not taking a position is wisdom, because you're safeguarding your capital. We want you to know how to also safeguard that capital by resisting. You don't jump on every bandwagon when you think that it's going to be profitable. You jump in. No. We want you to move in only when the market is clearly indicating that it's going to be a win for you. We want more wins than losses. That's the only way you make money in Forex. There are going to be many losses, but you're going to have more gains, and the more gains are going to cover for the losses, and they're going to make you a profitable trader. So let us continue on and complete this particular market structure lesson by saying this, that we should use technical indicators. Indicators can be used to identify trends, momentum, and potential reversal points. New traders should focus on a few key indicators such as moving averages, RSI, and MACD, and learn how to interpret them effectively. I think these are a repetition of what we had already mentioned somewhere about the indicators. So begin now to check out these indicators. You had learned about them, but now begin to see how they come into play where the market structure is concerned. Watch out for role reversals is the last part there. When price breaks a key level, that level often flips to become a new support or resistance. Pay attention to that, to when support levels become resistance and vice versa. So what this particular text here is talking about is that when you're in a trend and the structure is forming, what was difficult as a price level for a certain market time, it was a resistance level. After it is broken, when there's a breaking of that level, after that place which was a resistance, it becomes a support, because now the market does not want to go lower further than that particular price level. So you will understand this one in depth when we move into the immediate next lesson. The immediate next class is going to be on that. So we're going to deal with supply and demand. We're also going to deal with support and resistance. I hope you've understood market structure and you're now aware that those are some of the things we're looking for. So we're looking for the candle. We're looking at the candles. We did that. We're looking at the patterns. We did that. We are also incorporating the trends and looking at the trend, and we're looking at the structure. We also mentioned about the indicators, and that's why Forex trading and this whole trading arena, it is not a gamble. It's not an easy picky ponky kind of a scenario. No, it takes brains to be able to know these things, to remember these things, look out for them, mark them, and then now make a position available. With that, I want to close it right there. I hope you've understood what you needed to understand, so that you now know market structure. As we progress on, you will see the things that it is able to help you in determining what should happen. Thank you for now, and we'll see you when we're talking about supply and demand, and then support and resistance. Have a good time.